Hi there, welcome back to the channel. I'm Lynnor Anderson. I'm your San Diego realtor and I'm partners with my dad, Lyle. So if you are around my dad's age and would like to start to plan how you're going to downsize your home for retirement, you're not alone. It turns out this is a really big segment of the real estate market, especially here in San Diego. Boomers are wondering how to avoid paying that hefty capital gains tax on the sale of their homes. Don't worry, I've got you covered. In this video, we're breaking down what you need to know about capital gains taxes when selling your home, and in a way that it's super easy to understand. So let's dive in. All right, first things first, what are capital gains taxes? When you sell something like a house for more than you paid for it, the money you make is called capital gain. The IRS sees that as income, and that's where capital gains come in. If you've owned your home for more than a year, you're gonna pay a special tax rate called capital gains rate. But if you've owned it for less than a year, it's taxed like your regular income. Ouch! Now, how do you figure out how much profit you made? Here's the simple math. Take the total amount you sold your home for, then you subtract what you originally paid for it, along with any of the costs for big improvements that you've made, like a new roof or a kitchen remodel. What's left is your capital gain, but here's the good news. Not all of this profit is taxable. The IRS gives a special break for people selling their primary residence. If you've lived in that house for at least 2 out of the last 5 years, you can exclude some of your profit from taxes. If you're single, you can exclude up to $250,000, and if you're married, it's up to $500,000. For example, if you made $750,000 from the sale of your home and you're married, you can exclude up to $500,000. So only $250,000 of that is taxable. But wait, how much will you actually pay on that taxable part? Now that depends on a few things like your income and how long you've owned the house. For most people, the tax rate is going to be 15%, but it could be as low as 0 or as high as 20%. And if you have a really high income, you might also have to pay an extra 3.8% tax on top of that. Let's break it down with an example. If you and your spouse make $150,000 a year and you have a $250,000 taxable gain, you'd pay 15% in taxes, which comes out to about $37,500. But if your income is higher, like $1 million a year, you might actually be paying 23.8%, which would be $59,500. So here's the bottom line. While you might have to pay some taxes, you can reduce the amount that you're going to owe with that special tax exemption. And I don't need to remind you that selling your house is a big financial decision. So it's always ideal to talk to your accountant. They can help you figure out the best way to manage your money while you keep as much of it as possible. Now, I can't give you legal or tax advice, so be sure to check in with your trusted advisors on your specific questions. Otherwise, this is the easiest breakdown I can give you of capital gains taxes and how it applies to your primary residence. Hope this video helped you understand how those cap gain taxes are going to work in your behalf when it comes time to sell your home. Hey, if you are ready to have a conversation about selling your place, you can always reach out to us through the links down below. Hey, while you're there, be sure to get a copy of your San Diego Seller's Guide too. See you next time.